Something very unusual is happening in the world's most important financial market right now, and almost nobody is paying attention. The United States Treasury bond market, the $38.6 trillion foundation of the entire global financial system, is being quietly abandoned by the two countries that have historically been its biggest supporters, China and Japan. Together, they have dumped over $80 billion in U.S. government bonds in a single month. And the 30-year Treasury yield just crossed 5%, a level that historically signals serious stress in the system. The last time yields moved this fast, this high, the stock market crashed. Mortgage rates hit 7%. And the Fed was forced to make emergency decisions. Today, I'm going to explain exactly what is happening, why it matters to your money, and what you should do about it. Welcome to Financial News Daily. Let's get into it. Before we get into the sell-off, let me explain what U.S. Treasury bonds are. In the simplest possible terms, when the U.S. government spends more than it collects in taxes, which it has done every single year for decades, it needs to borrow money. It does this by issuing Treasury bonds. Investors, governments, banks, pension funds, and individuals lend money to the U.S. government. In return, the U.S. government pays interest on a fixed schedule and returns the principal at maturity. U.S. Treasuries have historically been called the safest asset in the world. Why? Because the U.S. government has never defaulted, and the U.S. dollar is the world's reserve currency. But here is the critical relationship every investor must understand. When investors sell Treasury bonds, bond prices fall. When bond prices fall, bond yields rise. And when yields rise, borrowing costs rise for everyone. Mortgages, car loans, business loans, credit cards. Every interest rate in the economy is anchored to Treasury yields. So when the 30-year Treasury yield crosses 5%, as it just did in May 2026, that is not just a bond market story. That is a you story. That is your mortgage story, your savings story, your investment story. Now, let's talk about who is selling. The numbers are staggering. According to U.S. Treasury Department data, in just the final months of 2025, leading into 2026, Japan, the single largest foreign holder of U.S. Treasury bonds, sold $25.6 billion in a single month. Japan's total holdings dropped to $1.0615 trillion, the lowest level since 2012. China, the second largest foreign holder, sold $9.6 billion in the same period. China's Treasury holdings have now fallen from $1.1 trillion in 2021 to approximately $759 billion today. That is a reduction of $341 billion in just 5 years. The United Kingdom sold $44.1 billion, the largest single country dump in that reporting period. Combined, just these 3 countries dumped over $80 billion of U.S. government bonds in a matter of weeks. Now, the critical question is, why are they selling? For Japan, Japan's own interest rates are rising for the first time in decades. As Japanese bonds become more attractive, Japanese investors are pulling money home out of U.S. Treasuries and back into Japanese assets. For China, the story is more strategic. China has been deliberately reducing its dependence on the U.S. dollar for years. As FX Street analysis confirmed, China is selling U.S. Treasuries and buying gold. The People's Bank of China has added gold to its reserves for 16 consecutive months. Since 2021, China has reduced its treasury holdings by $341 billion. And many analysts believe China holds far more gold than it officially reports. The message from Beijing is clear. We do not want to be vulnerable to the United States weaponizing the dollar against us, the way it was weaponized against Russia. And the bond market is sending that message in the form of rising yields. Motley Fool confirmed just last week, May 27, 2026. The 10-year Treasury yield climbed from 4.03% on March 3 to 4.69% in just 12 weeks. And the 30-year Treasury yield hit a 19-year high, crossing 5% in early May. This is not noise. This is a structural shift in who trusts U.S. government debt. Now let me quantify exactly what a 0.5% yield spike in 30 days means in real money. The 10-year Treasury yield moved from 4.03% to 4.69%, a 0.66% increase in approximately 12 weeks. Wall Street analysis confirmed the 3-year Treasury yield spiked 9 basis points in a single session, reaching 4%, the highest since June 2025. And the 2-year yield hit 3.98%, 34 basis points above the Fed funds rate, the widest gap since just before the SVB bank collapse in 2023. Why does this gap matter? When short-term market yields rise above the Fed's own rate, the bond market is telling the Fed, you are behind the curve. Rates need to go higher, not lower. This is the bond market sending a direct message to Jerome Powell, now Kevin Warsh, that the Fed has lost control of inflation expectations, and the real economy impact is already being felt. Mortgage rates crossed 6.52% in early May 2026, as Wall Street documented, up from 6.2% just 60 days earlier. At 6.52%, a $400,000 mortgage costs $2,530 per month. At the pre-war rate of 5%, that same mortgage costs $2,147. That difference, $383 more every single month, is what the Treasury sell-off costs ordinary homebuyers. For the stock market, Motley Fool was direct. Rapidly rising bond yields have historically been bad for the stock market. The recent rise in yields is near the tipping point for stocks. When the 10-year yield approaches 5%, high valuation stocks become mathematically less attractive compared to risk-free government bonds. Why take the risk of stocks when you can get nearly 5% guaranteed from the U.S. government? This is the question institutional investors are asking right now. And the answer is driving a slow rotation out of growth stocks and into short-term bonds and gold. Now, what happens if this Treasury sell-off continues through the rest of 2026? Scenario A. China and Japan continue reducing holdings. Yield on the 30-year Treasury pushes toward 5.5 to 6%. Impact on gold. Bullish. Extremely bullish. Here is the logic. If the world's two largest foreign creditors are abandoning U.S. government bonds, where does that money go? Historically, it goes to gold. China has already confirmed this, with 16 consecutive months of gold purchases. If sovereign wealth funds and central banks globally follow China's lead, gold demand surges. JP Morgan's $6,000 target becomes even more credible. Impact on stocks. Bearish for growth and tech. Neutral to slightly positive for defense and energy. As yields rise toward 5.5%. The mathematical case for owning high valuation stocks weakens. Money rotates from growth to value, from tech to defense, from speculation to dividends. Impact on real estate. Very bearish. 30-year mortgage rates. Following the 30-year Treasury yield towards 7.5 to 8%, would effectively freeze the housing market. For most ordinary buyers, the only active participants, cash buyers, institutional investors, those who don't need mortgages. Scenario B. The sell-off stops. A U.S.-Iran ceasefire is confirmed. Oil falls below $85. Inflation expectations cool. Foreign buyers return to Treasuries. In this scenario, yields fall back toward 4.0 to 4.3%. Mortgage rates ease to 6.0 to 6.3%. Stocks rally. Real estate sentiment recovers. Gold finds a lower base around $4,200. The key trigger to watch. The Federal Reserve's June meeting. Under new chair Kevin Warsh. Wolf Street analysis was direct. This will be the rubber meets the road test. For Warsh. He was known for being hawkish on inflation and favoring a smaller Fed balance sheet. If Warsh signals rate hikes, yields spike further. Treasury sell-off accelerates. Every asset reprices down. If Warsh signals patience, markets breathe. Yields stabilize. Risk assets recover. One man. One meeting. Potentially the most important Fed decision of 2026. Given everything we just covered, here is how I am thinking about positioning personal finances in a rising yield environment. Gold increased to 40%. The data is unambiguous. China is selling treasuries. China is buying gold. Central banks globally are buying gold. Inflation is at 3.8%. The Iran war is unresolved. Gold is the direct beneficiary of every single one of these dynamics. Short-term treasury bonds, 15%. Here is the key distinction. Short-term bonds, 3-month to 2-year maturity, are currently yielding 3.75 to 4%. These are safe and they pay you. Long-term bonds, 10-year to 30-year, are where the risk lives. Do not reach for long-duration bonds. In a rising yield environment, their price falls as yields rise. Stick to short-term only. Defensive dividend stocks, 35%. Johnson & Johnson, PG&Co, Walmart, LMT. These companies pay you dividends, regardless of what bond yields do. Their earnings are not disrupted by Treasury market volatility. Cash, 10%. In a volatile bond market environment, the opportunity to deploy cash at better prices comes frequently. Keep the powder dry. The one thing I would avoid: long-duration bonds, real estate with heavy leverage, high-valuation growth stocks with P/E above 30. These are the three asset classes most exposed to a continued Treasury yield spike. Let me leave you with the three questions every personal investor should be asking after today's analysis. Question 1. Do I hold any long-term Treasury bonds or bond funds with long duration? If yes, review that position immediately. Rising yields hurt long-duration bonds. Question 2. Is my mortgage rate fixed or variable? In a rising yield environment, variable rate mortgages are a ticking cost increase. If you have not locked in a fixed rate, now is the moment to consider it. Question 3. Does my portfolio have enough gold exposure to hedge against the dollar debasement narrative that China and Japan's Treasury selling is signaling? If the world's two largest creditors are quietly moving away from U.S. government debt, that is a signal worth taking seriously. Not with panic, but with preparation. The Treasury market is the deepest, most liquid financial market on Earth. Changes happen slowly, but when they happen, they affect everything: gold prices, mortgage rates, stock valuations, your savings yield. Watch the 10-year Treasury yield every Monday morning. If it crosses 5% again and holds above it, that is your signal that the sell-off is structural, not temporary. And before I close, the important reminder: everything in this video is for informational purposes only. This is not financial advice. All data based on publicly available market information as of June 4th, 2026. Please consult a qualified financial advisor before making any investment decisions. All information here is purely for your reference, to help you think clearly, not to tell you what to do. If today's Treasury analysis opened your eyes to something you hadn't considered before, please give us a like and hit that follow button. New financial insights every single day. Your financial future matters. Stay informed. Stay ahead. See you tomorrow, right here on Financial News Daily.